Okay, so I'm now starting to record. So in this lecture, it's the fourth lecture on cash flows. I'm going to be using question 11.5. Leanne, do you want to ask a question? Do you want to type it or do you want to put your mic on? Okay, the people who are busy with putting their hands up, you must either put a mic up, rather type your questions, and then if you do want to ask me something, put your hand up. Okay, so I'm using question 11.5 to discuss the differences between a sole trader and a company and the effect it will have on the cash flow statement. So you will find in your books that we do cash flow statements for a sole trader, cash flow statements for a CC, and cash flow statement for a company. I haven't seen any examples of cash flow statements for partnerships, so we won't be asking you that, but obviously a cash flow statement could be drawn up for a partnership as well. But the two options you have in terms of what we can ask you is we can ask you for cash flow statements for a sole trader and a company. So I'm going to use this question first to discuss the difference between the two. There are just a few things that would be different. And then we're also going to look at the preparation of the different general ledger accounts that you might need to reconstruct in order to prepare your statement of cash flows. And we'll particularly be looking at the retained earnings account and the equipment account, as well as accumulated depreciation on equipment. It's critical that you understand general ledger accounts to do cash flow statements. They're probably the easiest way to actually make sense of what the cash flow effects are of the various assets, liabilities, and income and expenses that happen in the business. So the reason we give you those general ledger accounts is not because you get marks for them, but they are how we work out what the cash flow effects are. So remember, we're always now looking in a cash flow statement for wanting to know how much money was actually spent, what was the outflow, what was the inflow. Anyway, okay, so that's what we want to do. You've got this on page 310 of your book. Sorry, it's a little bit unclear on my slide, but I've made 4 blue stars. You'll see the first blue star next to tax paid. So under cash flows through operating activities, a sole trader and a company will both have those first 3 lines that you see will be for both sole trader and a company. Sole traders and companies can also have interest received and interest paid. Dividends received, also a sole trader or a company, if they want to, they can invest in another company, buy shares in another company if they want to, and they will receive dividends. So dividends received could happen in a sole trader or a partnership. So you will see interest and dividends are something that we show separately under cash flows through operating activities. However, tax paid is not applicable to a sole trader. So you'll only see tax paid in a company, and dividends paid is only for a company. If it's a sole trader or a partnership, then it would be called drawings. So any drawings that the owner takes out would then be on this line instead of dividends paid. Under cash flow from investment activities, it would look exactly the same whether you're doing a sole trader or a company. But under cash flows from financing activities, obviously a company issues shares and a sole trader doesn't issue shares. In the sole trader, the owner makes a contribution. So if the company issues shares, then you get proceeds from issuing of shares, that's cash inflow. Sole trader, if the owner makes a contribution to the business, that will be an inflow. And payment of debentures is not generally something that a sole trader is actually going to be allowed to issue, so you won't find debentures with a sole trader. Okay, so those are main differences. The question today is for a company. Tomorrow's question that I'm going to do, question 11.3, I think it is a sole trader. And then the last question that I'm going to do on Monday is again for a company, and that's quite a big question. And that will be where we end up. Okay, so let's look at question 11.5. In your textbooks on page 310 onwards, there actually is a blank format that you could have used in terms of answering the question. You can use that if you like, but I'm going to be going through step by step, showing you how to put together the cash flow statement required of this question. So you are the accounting clerk at Mirage Limited. So first of all, just important to notice, we're working with the company. And you have to complete the financial statements for the year ended 31st of December 2004. And if we go and look at the required, it tells us here to prepare a statement of cash flows for the year ended 31st of December 2004. Okay, so they've given us a statement of financial position. Now, the statement of financial position has got the current year's balances and the prior year's balances, which are your opening balances at the beginning of the current year. Please make sure you take note of which is opening and which is closing. The additional information they've given us, sometimes they'll give you the full statement of profit and loss. Here they've only given us extracts, information from the statement of profit and loss. It's obviously not complete. What I do suggest, and I'll show you just now, is that you actually reconstruct the statement of profit and loss, because you need to do that to work out the money spent on operating expenses. And then there's additional information which usually tells you about equipment that's been bought or sold, for example. Okay, so that's the information that we have, and it's good before you start to have a look at what information you've been given. But before you carry on, the first step is now to think about the operating activities, because in our cash flow statement, that's the first section of the cash flow statement we need to prepare, is the operating activities. Now, you need to think about the operating activities as being the day-to-day business of the entity in terms of buying and selling, paying for things, receiving money, and so on. So when we look at the statement of financial position, we are interested in current assets because, remember, trade receivables and inventories are a result of your operating activities. Okay, so these are debtors, this is inventories that you sell. This has all got to do with the operating activities of your business. Under current liabilities, your creditors or trade payables, that's also to do with your operating expenses. And then current tax payable and dividends payable, this is a company. And we know that in the operating activities section, we also have to separately say how much was paid as dividends to the owners and how much was paid as tax to the owners. So we're going to work out those amounts as well. Okay, so those are the applicable amounts that we start looking at first in order to be able to do the operating activities section of the cash flow statement. Then the other information we're giving here, obviously, if we want to do the operating activities section, we need to look at the statement of profit and loss, because that shows us the operating profit that's been made for the year. And the additional information we're given here, this is applicable because we need to take note of the fact that the gross profit is 60% of sales, because we see here they've only given us sales. They haven't told us cost of sales or gross profit, but we'll use the 60% to work that out. And then they've told us dividends declared are 156,000 Rand. So that amount we need to be able to put into the dividends account that we're going to create, the shareholders for dividend. Just to have a quick look back here, they've also told us there's equipment that's been sold. Remember, loss on sale of equipment or profit on sale of equipment is not a cash flow item. We're going to have to adjust for it. It's the proceeds that you get from selling the asset that's the cash flow item. Dividends received are going to be shown separately, interest expense gets shown separately, and income tax expense gets shown separately. You might just want to take one last look back at your statement of financial position and take note that there is an account for current tax payable, that's your SARS account, and there is an account for dividends payable. Another name for that is shareholders for dividends. So that means we're going to have to reconstruct those two accounts, put in the amount for the actual income tax expense and the dividends declared to work out how much we actually paid in tax and how much we actually paid for dividends. Okay. So the first thing you're going to do is you're going to set out your format. Please, the format is important. We always give marks for the format. And they're easy marks, you need to memorize the format. So you put your name of the company and then you write statement of cash flows, and you must write for the year ended. It's not as at, because it's cash flows for the whole year and you put the year end date. Then I would divide my page into three, and I would have cash flows from operating activities. Usually that section requires a little bit more space. In fact, you should divide your page into 4, because you then also need to leave some space under cash flows from investing activities and cash flow from financing activities. So I would write these 3 headings first, and then I would complete the bottom section here, net increase, and then just put decrease in brackets, because you don't know whether it's going to be an increase or decrease. Remember, on the cash flow statement, whenever there's an outflow, it's in brackets. That means we've spent money. And then you need to have your cash and cash equivalents at the beginning of the year and the cash and cash equivalents at the end of the year. Remember, whatever we had at the beginning of the year, we add or subtract the inflows and outflows, and that will give us then the cash that we have at the end of the year. So these things that I've ticked are the things that you're going to write first, okay? You can write these things even without having looked at the question. There's certain information that's always going to need quite a big calculation. I do suggest you use a calculation column like this, so that when we're marking, we can go back and look at your calculations. Cash received from clients, cash paid to suppliers and employees are the first 2 lines under cash flows from operating activities, and they require normally quite a lot of calculations. So that's why I've already put calculation 1 and 2 there. And then the next line is cash generated from operations. Basically, what this means is that this cash generated from operations, we're comparing it to the profit that the business has made on the statement of profit or loss. But remember, the statement of profit or loss shows accruals for income and accruals for expenses. It's not necessarily the actual cash that we made out of the business. So we are going to, here under cash generated from operations, be working out how much money we actually made from our day-to-day operations in the business. Some information we can already complete. Interest received actually doesn't need to be here. I could have left that out. Dividends received, we saw in the question already, and the reason I've put it here is because they're marks that I can get already. Dividends received, this company obviously owns shares in another company and has received dividends of 8,000. There's nothing in the question that indicates that there are amounts owing at the end of the year with regard to these dividends. So we can assume the full amount is cash, and then we've got interest paid. And again, you need to just check the current liabilities section of the statement of financial position, but there's nothing indicating that there's an accrual for interest. So the full 24,000 that they've given us, we can now show as outflow of cash interest paid. If you go back to the required part of the question, here it is, the interest expense and the dividends. So I've started scoring marks, putting that straight onto the question. Something else I haven't read to you, but is also here, this point is about land, this point is about equipment, and I can see some equipment was sold, and this point is telling me that new equipment of 60,000 was purchased for the purposes of expansion. So I've got that information. There's no reason why I shouldn't use it immediately in my question. Purchases of property, plant, and equipment goes under cash flows from investing activities, and I've written there additions. These are the additions for expansion purposes, 60,000 Rand. You're also going to have replacements. The reason I've put replacements in is we do know that they've sold an asset and they've replaced the asset. So there will be an amount for replacements later on. But the point here is that I've put amounts in already based on what I've read in the question. Remember, you want to, as you're doing calculations, as you know figures, put them into the format as soon as you know the figures. Okay, so your first step was to set up the statement of cash flows and enter the information that was available. Please remember, you can type questions if you have them, and I'll have a look at it while I'm talking to you. All right, so what we're going to now is going to calculation 1, because we're going to be working out how much money was actually received from the clients. So in the question, we're told that sales were 6.5 million. Now in this question, they've made no difference between credit and cash sales. So we can make an assumption that everything is on credit. Whether it's credit or cash, it's actually going to make no difference to your answer. your debtors account gets debited. These are amounts that were owing by customers, and sales is the amount that would have been credited. So the 6.5 million is what was owing by customers, and we were given that information. They also gave us the opening balance. Debtors at the beginning of the year owed 108,000. So now just think about debtors. This is an asset, always has a debit balance. We start off with 108,000. We end with 72,000, okay? So that means that the debtors owe us less at the end of the year than they did at the beginning of the year. In fact, if you take the 108 and you subtract 72, okay, I'm not going to put all the noughts, you're going to get 36, okay? That basically means the debtors balance reduced by 36,000 from the beginning to the end of the year. So what we can say, therefore, is that we would have received 36,000 from our customers during the year because the amount they owed at the beginning was higher than the amount they owed at the end. So they must have paid us 36,000. So now what I can do is if I take that 36,000, which is the decrease in the debtors balance, and I add it to my sales amount of 6.5 million, it's going to give me this bank amount here of 6,536,000. Okay, that's the balancing amount in the debtors account. Another way of getting there is you take the opening debtors balance plus the sales amount. Opening debtors balance plus the sales amount gives you the total owing by customers, 6,608,000. And then you subtract what they hadn't paid yet at the end of the year, and that gives you then the amount that you would have received from customers during the year. So that's 6,536,000. You could reconstruct the ledger account like I've shown you. Otherwise, you can just take the 6.5 million and add this 36,000, and you get to the same answer. The reason we add the 36,000 is because it's an inflow. We've received money from our customers. So now you'll see, go back to your statement of cash flows that you've already prepared. Don't start your calculations until you've prepared the statement, and we put in the amount of cash that we've received from our clients. The next thing we have to do is work out cash paid to suppliers and employees. So when we look at cash paid to suppliers and employees, we first of all always need to look at how much was spent buying inventory, and then we're going to look at how much was spent on other expenses that was not inventory. So this calculation has two parts. We have the amount spent on inventory and the amount for other expenses. So the easiest way of doing this is you need to work out how much was actually paid to the creditors. That's what you're looking for. Cash paid to suppliers. Creditors are your suppliers. They give us the opening balance of creditors. Remember, this is a liability. So at the beginning of the year, we owed creditors 96,000. The end of the year, we owed them 108,000. Okay? So those balances are given to us. We don't know how much was purchased during the year. This amount here is what we would normally be purchasing. So we would debit inventory, credit creditors, assuming we're using the perpetual method. But that amount you don't know. For that reason, you have to go back to your inventory account, and this is going to become the balancing figure in your inventory account. Because in your inventory account, you know the opening balance of inventory. This is an asset, and they tell us we had 192,000 at the beginning of the year. The end of the year, they tell us we had 360,000. The other thing they tell us is that, we can work out how much the cost of sales is. So the 192 and the 360, they've given us this cost of sales amount. I work it out because they've told me how much sales were, and they've told me my gross profit percentage. So if I just go back here again for a moment, let's go and look at that information. Here's the sales, and here's the gross profit percentage. The gross profit percentage is 60% of sales. So in other words, if sales are 100%, then cost of sales is going to be 40%, because gross profit, they tell me, is 60. Okay, so gross profit is 60% of sales. So, okay, somebody said there's something wrong with my mic. Who else is having a problem? Let me ask this question. If you can hear me, please put up your hand. Okay, so the student who said there's something wrong with my mic, maybe just check your own settings, because it seems like most other people can hear me. Okay, sorry about that. But you'll also remember be able to watch the recording. Thank you. It seems that most people can hear me. Okay, so what I was saying here is that the sales would then be, because it says gross profit percentage is 60% on sales, that means that gross profit is 60%, sales is 100, which means cost of sales is 40%. So if I now go back to this ledger account that I was busy preparing for inventory over here, what I can say to calculate this is I just take my sales amount, which was, sorry, I just need to find it again in my question. I think it was, and I times that by 40%, okay? And that's going to give me the 2,600,000. So that cost of sales amount is what you would normally then be debiting cost of sales, crediting inventory. Remember, inventory, when you buy it, you increase inventory. When you sell it, you decrease inventory. So this is the entry that would have credited inventory, debited cost of sales. So that's taking inventory out and debiting it to expenses. So we know we had the opening balance and the closing balance, and we've worked out the cost of sales amount, which means the balancing amount in the inventory account is therefore the amount that we've spent buying inventory during the year. So this 2,768 is therefore the debit to inventory and the credit to creditors. So the 2,768 represents inventory purchased on credit during the year, and we had to go and reconstruct the inventory account to get to that amount. Now, because I know how much was owing to creditors at the beginning and the end of the year, and I know how much we bought on credit, I can now work to what was the amount I actually paid my creditors. Remember, when you pay creditors, you're going to credit bank, debit creditors. So I take the opening balance owing to creditors, I add what was purchased from them during the year. That gives me 2,864. And that, I'm going to answer your question now, Wesley. That 2,864 I take across to this side and I subtract 108,000, which is the amount I hadn't paid by the end of the year. And that means the amount I actually paid to my suppliers was 2,756,000. I just want to, did I make a mistake when I said debit bank and credit creditors? Sorry, I just realized I don't have the question open in front of me. I just want to get it. I'll just be a minute, because otherwise I'm going to make mistakes when I talk to you. Okay, so first of all, let me just ask, yes, so I see Ashraf has actually answered Wesley's question. The reason we're timesing by 40% is because we're looking for the cost of the sales. So Wesley, they tell us the gross profit is 60%, but I'm not going to, yes, you can answer some of the asked questions by other students. Thank you, that will really help me, because it's quite difficult to actually be presenting and answering at the same time. So Wesley, they have answered you. The 40% is because we're looking for the cost price, not the gross profit. Abdullah, I'm not sure if I did say debit bank and credit creditors. It should be debit creditors, credit bank, because creditors are reducing, we're paying them, and the bank account is reducing, so we credit the bank account. So this 2,756,000 is therefore the amount we spent paying suppliers. So the next thing we can do is on cash paid to suppliers, employees, I'm going to write there the 2,756,000 because that's the amount I paid to suppliers, and I've got to add to that the rest of my operating cash expenses. So now we're going to go and work that out. What I suggest you do, this is different from the way it's done in a lot of the solutions. It doesn't really matter which way you want to do a calculation. The calculation must make sense to you, and you obviously just need to make sure you're coming up with the right answer. What we are looking for here is we want to know how much were cash expenses. We already have, for cost of sales, we've already worked out now how much was actually paid to suppliers, okay? So there was your sales, and the cost of sales is 40% of that, and the gross profit is 60% of that. Sorry, I'm not writing very well with my mouse. So dividends received, remember, we're going to show separately, and loss on sale of equipment is not a cash flow item, and finance costs we're going to show separately. So we need to work out how much was spent on expenses that were cash expenses. In this question, there will be depreciation, but we don't know the amount of the depreciation. So that means we now need to go and calculate the depreciation. The reason we're doing that is because we need to know how much were the cash expenses, and that would exclude depreciation. But we have another problem, and the problem is that in this question, we don't know how much the net profit is, okay? So I need to first work out the net profit, then I'll be able to go and work out what the other expenses are. Because remember, if I take gross profit plus dividends minus other expenses minus finance costs, it's going to give me the net profit. So I first have to work out the net profit so I can work backwards and work out other expenses, and then I'm going to be subtracting the depreciation and the loss and sale of equipment from those other expenses, and I'll finally end up with my cash expenses. So this is a bit of a process that you have to go through. What you need to always remember is, what is it I'm looking for? I'm looking for cash expenses. The easiest thing that makes sense to me is to reconstruct the SPL. So to work out the net profit, you're going to have to reconstruct the retained earnings account. The retained earnings account has an opening balance. Remember, this is equity at the beginning of the year of 220,000. And at the end of the year, we have equity of 268,000, okay? Retained earnings, rather. So those balances are given to us. The other thing that we do know is that there were dividends that were paid of 156,000. Sorry, declared. Let me not say paid, declared. Declared means that's the dividend expense, if you like, for the year that the company has decided to award to the shareholders. So dividends are always going to reduce your retained earnings. It's like drawings. It's a reduction of the accumulated profits or the retained earnings of the company. Okay, so we are going to be debiting retained earnings and crediting shareholders for dividends. It's not too serious whatever you've written here, because remember, you're not getting marks for this account. But if you were going to do the retained earnings account for marks, then you would have to just think about what you need to write here. But for the moment, it doesn't matter. We're just writing dividends. So we know these two amounts. So the debit side of the retained earnings account adds up to 424,000. The retained earnings account, therefore, has a balancing amount of 204,000, which would have come from our profit and loss account. Remember, the end of the year, all of the income and expenses get closed off to the profit and loss account. The balance on the profit and loss account must have been a credit balance. So we would have debited the profit and loss account and credited the retained earnings account with this amount of 204,000. Okay. It's important to remember this amount is after tax. All right. So tax is something we show separately on the statement of changes in equity. So it's important to think about the fact that this number is after tax. So we reconstructed the retained earnings account to get to the profit or loss amount for the year. So it's the profit of 204,000. So we put that, sorry, let me go back one. We put that 204,000 here at the bottom of our reconstructed statement of profit and loss. The taxation expense they've given me in the question, they've told me that the tax expense for the year is 120,000. That means the net profit before tax must have been 324,000. I add the 204 and the 120, that gives me the 324,000. Because I now know this net profit amount, I can now go and work out what my other expenses are. You please need to work with this yourself a little bit, make sure you understand. You take your gross profit, add your dividends, subtract your finance costs, and then subtract this net profit. And you will then get this amount of 3,560,000. Sorry, I realized I should have put this in a bracket because this is an expense amount, okay? So those are your total for other expenses. So we've got one step closer to working out our cash expenses, but what stands in our way is that we still don't know the depreciation amount that would have been included in other expenses. Okay, so that's what we now have to go and do, is work out this depreciation amount. Once we know that, then the cash expenses will become the difference here between these two non-cash flow items and the total amount of the expenses. So if we now go and reconstruct these accounts, the equipment account accumulated depreciation on equipment and asset realization. So in the question, we have equipment that starts with an opening balance of 300,000 and has a closing balance of 360. We have accumulated depreciation that has a credit opening balance of 158 and a closing balance of 204. That information was given in the statement of financial position. If I quickly go back and look at the additional information given in the question, sorry, it's a few slides back here, they tell us that no land was disposed during the year, and I'm not interested in land because land doesn't have depreciation. If I go back and look at my, okay, Mishka, if you want to put on your mic, then you can ask me a question. And Anelga, do you girls want to ask something? And you can put up your hand. Okay. If you don't want to ask something, it's fine. Okay, just going back here, the reason I'm going back here is I just want to see there's land and there's buildings, there's equipment, and there's accumulated depreciation on equipment. Normally, I'll only look at this when I'm looking at investing activities. The reason I'm looking at this now is because I want to see what's going on with depreciation, because they haven't told me how much the depreciation is for the period. Okay, Tinashe, do you have a question? You can put on your mic. Because I see you put up your hand. Okay. Try not to put up your hand if you don't want to ask me something now. Otherwise, type a question, and at the end, I think I'll take questions where you can actually talk to me. Okay, so what was I saying? I'm saying I'm looking for what's happening for depreciation. So the only amount that has depreciation is equipment. And here I've got those opening and closing balances that I used. And over here, they're telling me that during the year, some equipment was damaged and it was sold at a loss of 9,000 Rand. That 9,000 Rand is over here, but remember that's not a cash amount. The original cost of the equipment was 40, and the accumulated depreciation on the date of sale was 12. Okay, so we're going to need to use that to reconstruct the asset realization account and to reconstruct the accumulated depreciation account. We already know that new equipment of 60,000 was purchased for the purposes of expansion. While the rest of the equipment acquired was for replacement, the trick here is they don't tell you how much was acquired. So that's also why we have to reconstruct the equipment account. So let's go back to the ledger accounts for equipment. Okay, so we had the opening balances. I'll just tick those again, and the closing balances were given to us. Then what I'm looking for, most crucial, is this amount. While I'm busy working out this 58,000, there are going to be a few other cash items that I'm also going to be able to get at the same time. And when we're dealing with equipment, we're dealing with investing activity items. Okay, so when you're dealing with an asset, a PPE account, you're always looking for, was there anything that we purchased during the year? And how much did we pay? And you're also looking, was there anything that we sold during the year, and what did we sell it for? Okay. I see Tinashe, do you want to ask something? I prefer that we ask at the end, but you can put your mic on if you really do need to ask. Okay, now, so the information we have is they tell us that the asset that we got rid of was 40,000. That was the cost. And they tell us the accumulated depreciation was 12. Okay, so I put the accumulated. Okay, so it's fine. I'm going to ignore the hands from now onwards, okay? The accumulated depreciation is 12. You'll see here, I now actually have enough information because I'm taking out the 12,000 for the equipment that I got rid of. I've got the closing balance and I've got the opening balance. So I can actually now work out my depreciation for the year. But while I'm busy working these amounts, I'm just going to get the equipment amount that we've purchased and the amount that we receive for selling the equipment at the same time. So in your accumulated depreciation account, you always have the opening balance on the credit side. You're going to debit depreciation, credit accumulated depreciation with the depreciation for the year. And then if there's any asset that you sold, you take that accumulated depreciation out on the debit side, and the closing balance is what you're left with. If we now go back and look at our asset realization account, they do tell us there's a loss in sale of equipment. That means we're going to credit the asset realization account and debit loss on sale of equipment with 9,000. What we can think about in this question is the asset cost 40 and the accumulated depreciation was 12, which means the carrying amount of this asset was 28,000, okay? The difference between the cost and the accumulated depreciation. So if I made a loss of 9,000, it means I only received 19,000 when I sold this equipment. And you can see that this is the balancing amount here. On the debit side, we had 40. We carry it across. We subtract the accumulated depreciation and the loss of sale of equipment, and that gives us the amount of cash that we actually received. Okay, so that I'm going to put onto my statement of cash flows now as well. And then finally, if I go back to my equipment account, the 60,000 that was additional equipment that was bought was given to me already. So that entry would have been debit equipment credit bank. And this then becomes the balancing amount in this ledger account. We have 400,000 on the credit side. We're going to subtract our opening balance and the 60,000 for the additions of equipment during the year. That leaves us with 40,000 as a balancing amount on the debit side of the equipment account. That means that's the amount we spent on replacing the equipment that we sold. Okay, so we've got a few cash flow items now that we've worked out that we'll also be able to put onto our statement of cash flows. But if we go back first of all to our reconstruction of SPL, the depreciation amount was 58,000, and I'm now going to put that 58,000 in here, which means I can work out my cash expenses because I already know how much my total expenses were. So if I subtract the non-cash items, that leaves me with my cash expenses of 3,493,000. So that was quite a long process you had to go through, reconstructing the statement of profit and loss, first working out the profit for the year, then having to work out depreciation, and then finally getting to your cash expenses. So where does that go? If we now go and look at our statement of cash flows, here is the 3,493,000. We add that to the amount we paid to suppliers for inventories, and that will give us then the total amount we paid to suppliers and employees, 6,249,000. If I subtract that from my cash received from clients, then it means I've made 287,000 rands worth of cash this year from operations. Okay, so that information we had in the question. You will also notice here that I've added the 40,000 next to the replacements. I'm not sure if there's going to be anything else. It's actually better to rather put it next to the amount rather than putting it into the total column yet, because there might be other amounts you need to add. So the 60,000 they told us, the 40,000 we just worked out that the equipment that we bought to replace the equipment we sold was 40,000, and we also worked out that the amount of money we received for the equipment we sold was 19. So those amounts I've already jotted down there so that when I get to the end, I can just take them across and put them in the total column. Okay, the next amounts we need to work out are tax paid and dividends paid, and then we'll be finished with cash flows from operating activities, which is the major part of this question. So you will remember I showed you just now that the current tax payable account is showing under current liabilities. It had an opening and closing balance, and the dividends payable account also had an opening and closing balance that was given to us. So this is the amount of money that we owe to SARS for tax, and this is the amount of money we owe to shareholders for dividends. So we do know they told us for the year we would debit tax expense, credit current tax payable, and for the dividends payable, remember we debited retained earnings, credited dividends payable with 156,000. So we've got these amounts on the credit side. Then if we take the closing balances away, we get to our bank amounts. So if we just think quickly about the tax amount, the balance at the beginning was 240, plus we owe another 120 tax for the year, meaning we owed a total of 360. At the end of the year, we still owed 60,000, which means we must have paid 300,000 worth of tax. For shareholders for dividends, we owed them 28,000 at the beginning. We have another 156,000 of dividends we owe them. That means we had 184,000 that we owed to shareholders. But at the end of the year, there was only 36,000 that hadn't been paid yet, which means we must have paid shareholders 148,000 already for the dividends that we owed. So we can now finish the operating activities section of our cash flow statement by putting in the 300,000 for tax paid and dividends paid. Very critical that you put the brackets in. If you don't put the brackets in, you won't get the marks. So here's the tax paid and dividends paid that I've just calculated. So you take your cash generated from operations, add dividends received, subtract these amounts, and you get 177,000, which then is your cash flows from operating activities. And that's an outflow actually, because you can see the amount we spent on tax and dividends was quite substantial in relation to the cash that we generated from operations. The bank amount we're going to balance at the end. Okay, Marissa's asking me that. We exclude the bank account when we're looking at current assets and current liabilities. We work with it when we balance right at the end over here. Okay, so the cash flows from operating activities dealt with debtors and creditors, it dealt with inventories, it dealt with shareholders for dividends, current tax payable, and we also were looking at our statement of profit and loss to try and work out what was the cash received from customers and the cash paid to suppliers and employees. Now we're going to go on to the investing activities section. We've actually done some of it, so this isn't going to take that long. What you need to now do is look at your non-current assets, okay? So in this question, we have land, buildings, equipment, accumulated depreciation on equipment, and financial assets. So in the investing activities section of the cash flow statement, we try to see what was the amount of money we spent investing in non-current assets. Something else that's quite important to look for in the equity section is a revaluation reserve, because you will remember that we can revalue, and I think in Accounting 1-to-1 we've only revalued land, right? We can revalue land, and you will see this revaluation amount has actually increased. And when we revalue them, so what this means is that this revaluation amount had an effect here on this land amount, and we're going to need to reconstruct the land to see what is the actual amount that we may be spent buying more land, taking into account the fact that we did revalue land. Buildings, there's nothing last year, 128,000 this year, so that immediately looks like an addition of property, plant and equipment. Equipment we've already done, accumulated depreciation on equipment we've already done, so we don't need to worry about those two. We're just here looking now at land and buildings, and then finally we're also going to look at financial assets. So these could be any investments that the business has made. They had 182,000 of investments at the end of last year. The end of this year, it's 288,000. In other words, they've spent another 106,000 this year buying more investments. Okay, so that 106,000 is going to be an outflow of cash. So here we've got 106,000 outflow, and with buildings we've also got 128,000 outflow. If we just check the additional information, it tells us no land was disposed of during the year. What it doesn't tell us is whether any land was acquired or not. We'll need to check that. The equipment we've actually dealt with already. So the only account we really don't know what's going on in is the land account. So we're going to reconstruct the land and revaluation reserve accounts. So the land account had an opening balance of 600,000 and a closing balance of 760. The revaluation reserve, remember this is equity, and we had an opening balance of 70,000 and a closing balance of 170,000. That means we increased the revaluation reserve by 100,000 for the year, and this journal entry is we would have debited land, credited revaluation reserve. So here there would have been a debit of 100,000 to land. That means if we now look at our land account, we had a closing balance of 760, we had an opening balance of 600, we revalued land by 100, which means there's a 60,000 balancing amount, which must be for additional land that we purchased during the year. Okay, so that 60,000 is something that wasn't evident from the question. The things that are evident sometimes are the things they don't say. So you had to notice the revaluation reserve, and you also had to notice that they said there was no land disposed of during the year. They didn't tell us there was no additional land acquired during the year. So that's why we had to check, and we looked at the land account and we see there was 60,000 rand. That's the only cash amount relating to land. So if we now go and look at our cash flows from investing activities, we can complete that. This 60,000 was the equipment amount they gave us. The 128,000 is the buildings, and this 60,000 is the land that we purchased. That all goes as additions. So additions are for assets that you didn't have before. Usually they're for expansion purposes. So it means I've spent 248,000 here on purchasing additional assets. I know that I've replaced equipment, and that amount is 40,000, so I take that across. Don't forget your brackets. I sold equipment. The amount I received for selling was 19,000. That doesn't have a bracket. We worked out the purchases of investments that we spent an extra 106,000 this year purchasing investments. So that 106,000 is in a bracket. So you can see here, this company spent a significant amount of money. If I add everything up and subtract the proceeds on the sale of equipment, they spent 375,000 on investing activities for the year. Okay, so they would have needed to get money from somewhere because they spent money on operating activities, on investing activities. So we need to look at what the financing activities look like for the year. Okay, sorry, let me go back. So with financing activities, you will have noticed, we've actually dealt with everything under assets except for bank. We're going to come back to bank, and here we've dealt with current liabilities, except there's a bank overdraft. We'll deal with that just now. And the last section of the statement of financial position that we still need to deal with is therefore the equity and non-current liabilities section, which is your financing section. That's how you financed your business. The owners and outside parties provide finance to the business. So if we look at these accounts, ordinary share capital increased from 324,000 to 432,000. That means we must have issued another 108,000 rands worth of shares during the year. We would have received 108,000 from shareholders. We would have credited ordinary share capital, debited bank. The preference share capital hasn't changed, so there's nothing we need to worry about there. It hasn't changed at all. The revaluation we've already dealt with. We know that there's no cash effect with revaluations. It's really just a book entry that we do. The retained earnings account, you will remember we've already done. And in that retained earnings account, there's nothing affecting financing activities. Okay, so actually the only amount that's going to affect financing activities is the increase in ordinary share capital. Then if I look at debentures, so debentures are like blocks of loans that you sell to people and they give money to the company and they get a debenture certificate. We had 200,000 worth of debentures, now we only have 156. So we must have spent 44,000 repaying debenture amounts to the debenture holders. So we're going to put that 108,000 and the 44,000 under the financing activities section. There's nothing under the additional information we need to worry about. The retained earnings account, remember I said to you, we've already reconstructed it here. We've already taken note of dividends. We've already taken note of profit and loss. There's nothing we need to worry about in the financing section. So I can complete the financing section by putting in the amount I received from issuing shares and the amount I spent on redeeming debentures. So that means I had an inflow of 64,000, that's 108,000 minus 44,000 from financing activities for the year. That's a little bit of money that came in because you would have noticed that with investing and operating activities, we were spending money rapidly. So we finished those three sections. Now remember what I said to you yesterday, that quite often in a test, we actually won't ask you the whole cash flow statement and the exam. We're only going to be able to ask you a portion of it because we've got to ask you a whole lot of stuff in the 2-hour period. So you must be able to reconstruct just part of the statement of cash flows, like the operating activities section or the investing activities section or the financing activities section. Let's now finish off the last section where we look at balancing to the bank accounts. So you can see here we had money in the bank at the beginning of the year of 276,000, but at the end of the year we had an overdraft of 212,000. So you can see if we take plus 276,000 and go down to minus 212,000, we spent close on 500,000 Rand during the year. We took that out of our bank account. If you add up your cash flows from operating activities, that's an outflow. In investing activities, that's an outflow. And you add the inflow from financing activities, you will see we spent 488,000. That is the decrease in cash and cash equivalents for the year. Our opening balance was a positive balance of 276, but if we subtract the 488,000, that comes then to the closing balance for cash and cash equivalents of 212,000. With regard to balancing the statement of cash flows here at the end as well, I said this yesterday, we are not going to be asking you to do a balancing exercise for us. That's not what we want to test when we're testing you on cash flow statements. So these amounts, if you get asked to do the section of the cash flow statements, you just put in the amounts that you've worked out and put them in. If it doesn't balance, don't worry, carry on, because you're going to be getting principal marks and you will not be getting marks for making things balance. Okay, so don't worry about making the cash flow statement balance, but obviously in real life one does need to make cash flow statements balance, and companies have to every year prepare a cash flow statement together with their statement of financial position and their statement of profit and loss. Okay, that lecture is now finished. What I want to say to you is that tomorrow I'm going to be doing question 11.3. It's actually quite a short question. I know it's Friday, but I am going to be presenting tomorrow that short question. Monday is a long question, and that's a company's question. So I think that one is actually quite important for you to listen to as well, although you're also very welcome to join me tomorrow again at 11:45. Okay, so that's the end of today's session. Questions? Did you all understand everything perfectly? Don't be shy, you can type. Okay, Tinashe and somebody else, do you want to put on your mics? Then you can talk to me. Okay. All right, so there are a couple of people. Tinashe, do you want to go first? I can't hear you. Okay, so you need to put your microphone on if you want to ask a question.
Hi.
Okay, Kay, your mic is on. Go ahead. Yes?
In regards to working out the other expenses, sorry.
Yes.
When you were showing us the slide, I couldn't understand how you got the total before you did the depreciation and the loss and sale of asset. It worked at 3,000.
Let me just go back to the slide. Okay, then you can talk to me. Let me just get the slide. It was the reconstruction, this one.
No,
this slide.
This one, yeah.
Yeah. Yes. Okay, just tell me what you don't understand.
In one of the slides, you already had the total of 3,560,000. You had it in already before you put the 9,058 and now the cash expenses amount. I want to know, how did you work out the total before you worked out the depreciation? Yes.
Yeah. Okay. Now I get what you're asking. So the numbers that I knew I put in first. So I knew the gross profit and I knew the dividends. I knew the finance costs. Then remember, I had to go and work out the profit after tax, and I knew the tax amount, so I could work back to the net profit before tax. Okay, so that 324,000 I knew, but I didn't know the 3,560,000. But can you see that if you know the gross profit and you know the dividends and you know the finance costs and you know the net profit, this becomes a balancing amount. Okay. In other words, if I take that 3.9 million and I add 8,000 and I subtract 24,000 and then I subtract 324,000, it's going to give me the other expenses, because that's the amount that's missing. It's like putting a puzzle together. You're putting in the piece that's missing.
Okay, I understand. Thank you.
Does that make sense? Okay, perfect. Yes. Anyone else with a question? Please put your mic on. Okay, Kay, do you want to ask again? Because you need to put your mic on. Okay, somebody's written something here. Okay, so Sibeso, I answered that 3,560,000. And Kay said there was a mistake. All right, anybody else? Okay, so Clinton's asked a question. If an asset is being traded in, how will this affect the statement of cash flows? All right, let's think about this. If you trade in the asset, what that means is that you're going to effectively be paying less for your replacement asset. So all that's going to happen here, remember on your statement of cash flows, you only want to show cash amounts. So there will be no cash amount received for the asset that's been traded in. There will only be a cash amount that's paid for the asset that you're buying. Okay, so the cash amount that you paid for the asset that you're buying will actually be less than it would have been if you didn't have a trade in. So if I want to just summarize what I've said, if an asset is being traded in, you actually then only show the amount you paid for the asset that you bought. There'll be nothing showing as cash received from proceeds of sale of asset, because it wasn't actually a cash amount that you got in. It means you had less cash to pay when you bought the new asset. Is that okay, Clinton? Okay, please explain the depreciation part. Do you mean the 58,000 here, Refilwe? I presume so. The reason we want to know this is because this 3,560,000 is not all cash. And the non-cash amounts that we're telling you about in FRK 121 are, if there's a loss on sale of equipment, that's not a cash amount, because remember, the amount you receive when you sell is the cash amount. So depreciation in this question was something we didn't have. We needed to know it because we needed to work out what was the actual cash expenses, okay? So to get to cash expenses, we took our total expenses and subtracted the non-cash amounts, okay, to get here to the cash expenses. So to calculate the depreciation, what we did is we went to the accumulated depreciation. Sorry, I'm going the wrong way. We went to the accumulated depreciation and equipment account, because if you went back and looked at your statement of financial position, this was the only asset on which there was depreciation. So I reconstructed this account. This was the opening balance and this was the closing balance. And the 12,000 was the accumulated depreciation on an asset that I sold. Remember, the entry for that is you take it out of accumulated depreciation and you credit asset realization. So that means then that in this accumulated depreciation on equipment account, remember this is a negative asset. This 58,000 becomes my balancing amount, which is my depreciation amount for the year. The entry would have been debit depreciation, credit accumulated depreciation. So I took the 12 plus the 204, it gave me 216,000. I subtracted 158,000, and that gave me the 58,000 depreciation that I needed to be able to then work out what are the non-cash flow items so that I could subtract them from the total expenses to get to the actual cash expenses for the year. Okay. Refilwe, I hope that's okay. Jordan says, how would we determine how many general ledger accounts we need to reconstruct in order to find the amount that goes on the statement of cash flows? Well, that's why I think it's important that you are following when I'm doing a lecture, is because it depends. Tinashe, I'll come and answer your question now. So it depends very much. You actually don't have to reconstruct general ledger accounts, but I find for me, I've been doing cash flows for years, I find it very confusing if I don't do general ledger accounts. So you have to think about the items that are needed. Let's just maybe go and look at the cash flow statement. And I'll tell you about where generally you have to reconstruct general ledger accounts, although you won't always have to. But in cash received from clients, you're generally going to have to reconstruct the debtors account. Cash paid to suppliers and employees, you're looking at reconstructing inventory and creditors and reconstructing the statement of profit and loss. With interest received, dividends received, interest paid, the only time you would have to reconstruct here, and it doesn't seem to me that we do this with you in FRK 121, is if there were any amounts that hadn't been paid or were still due at the end of the year. But with tax paid and dividends paid, you have to reconstruct the current tax payable account, and you have to reconstruct the shareholders for dividend account, okay? So what I'm trying to do here is just tell you which ledger accounts you normally have to reconstruct for which line items. Then when you get to investing activities, you're looking at reconstructing your cost and accumulated depreciation accounts. the accumulated depreciation account generally is reconstructed so that you can take out the non-cash expenses for suppliers and employees. And the actual cost accounts for property, plant, and equipment, you reconstruct so that you can get the cost of additions and replacements. And then if there are assets sold, you have to reconstruct the realization account to get the proceeds. Cash flows from financing activities. So just go back there. The land, I reconstructed the revaluation reserve because there was one. Sometimes there won't be a revaluation reserve, then obviously you don't need to reconstruct it. Cash flows from financing activities, you don't often have to reconstruct accounts there because normally if you just take the closing balance minus the opening balance, you get the cash flow effect. But there could be the odd case when you might need to, but I haven't seen a question like that yet that we've given you guys. So with regard to general ledger accounts, those are the ones you're normally going to need to reconstruct. But don't go and start reconstructing them until you've thought a little bit about. Sometimes the number might actually be there and you don't need to reconstruct. So example, for tax paid, if you don't have a taxation payable account in your current liabilities, it then means you can assume the tax paid is the cash expense and the actual expense for tax are the same, that everything was paid to SARS for the year and you would then not have to reconstruct your SARS account. And dividends owing to shareholders, the shareholders for dividend account, you also don't have to reconstruct it if you don't see it on the statement of financial position. Okay, so that was Jordan's question. So I just want to now go to Tinashe is asking me the balancing amount of 40,000 in the equipment account. I just want to go back to my equipment account. What did we do with it? Okay, so in this equipment account, this 60,000 I got from the question. They told me that I bought additional equipment of 60. And then the 40,000 was the balancing amount in this account. And that was then for the equipment that I replaced, for the equipment that I sold. So if you now go and look at the statement of cash flows, I'll show you what we did here. I just want to go to the next statement here, where I did the investing activities. Here we go. Here's the 60,000 for the equipment that they told me about in the question. And here's the 40,000 for the equipment that I replaced. So you'll see I separated it between additions and replacements. So both amounts are there. And then the 128,000 was the increase. Kiara's asking me for this. If you look at your statement of financial position, there's 128,000 for buildings. That wasn't there the prior year. Okay, if I can just go back and look here, you'll see here there's 128,000 for buildings, and there was no balance last year, so that's an increase in buildings for the year. So I think I've answered Tinashe and Kiara, and then Obakeng answered Kiara as well. Okay, any other questions? Everybody happy with my answers? Anything else you want to ask? All right. Great. Thanks, guys. Good luck with your studying, and please join me tomorrow. And also email me if there are any sections that you're working on that you want me maybe to do additional classes on next week.